Good morning, everyone. It looks like we're just live here at the top of the hour. I want to say a quick good morning, good evening, good afternoon, as the case may be. We have a worldwide audience today. We're streaming across 3 platforms. We're in 3 time zones right here on this screen alone. So this is pretty exciting. I'm seeing a lot of signups right now. Some names I recognize from the traditional finance, the decentralized finance, and just general economic space right now. This is really exciting. Really excited for this conversation. Second of our series here. So without further ado, we'll kick it off here. Quick background on me: August Widmer. I manage our DeFi partnerships over here at Credix, and have the pleasure to sit down with a couple of smarter minds than myself here and pick their brains a little bit, get their insight on what they're doing and how they're collaborating. So enough about me. I'll hand it over here and kick it off with just a quick question. Perhaps, Ankit, we begin with you. Could you give us a quick intro on you, but then also your company, what you're doing, et cetera?
Sure. Thanks, August. Very modest introduction for yourself. I'm also going to do a very small one for myself. So I've been in TradFi for the past decade. I was a trader at Barclays, managing a derivatives book for close to $1.5 billion. I was one of the founding members of SEBA Bank in Zug in Switzerland, one of the first FINMA regulated crypto banks, and I was the head of Quant Solutions. I joined Mudrex as a co-founder last year, and I head the Mudrex Capital branch, which is basically the institutional arm of Mudrex. Here we are basically trying to build a quantitative hedge fund on only focused on cryptocurrencies, and we're trying to explore the TradFi ideas and emulate them into cryptocurrencies and kind of create quantitative systematic strategies and basically be market neutral as we go along. So Mudrex Capital itself is the institutional arm, but we also have a couple of other arms at Mudrex, which we deal with more retail and DeFi side.
Really interesting. Okay. So you've alluded to it a little bit, but perhaps you could give us a clear delineation on the difference between Mudrex and then Mudrex Capital. And it sounds like you're heading up the capital side.
Yes. So Mudrex Capital, as I mentioned, is the institutional arm where we focus on clients who are accredited and with a minimum investment size of $100,000. It works as a hedge fund in the traditional finance, mnemonics, but the way we treat Mudrex Capital is basically we want to generate systematic, steady yields over a long period of time without facing the same drawdowns as cryptocurrencies do. And on the Mudrex.com side, we're building out one of the world's biggest investment platform for cryptocurrencies, where we are trying to make it really easy for retail investors to get into crypto and get into really simple products, which can generate really long-term wealth for them in the course of time. So we have products like CoinSets, we have products like Vault. Basically, we're trying to diversify investments in long-only portfolios as an index and rebalance every month systematically, rule-based, no human bias. And we also have a Vault, which is a product which generates 10% APY fixed. And we are getting up to a few of other products which are going to come on the retail side. So it's all accessible through the phone. We are live in Europe, we're live in Turkey, we're live in India, and we are coming soon to the US.
Really exciting, really exciting. I think building out that more user-friendly, retail-focused front end is a great way for onboarding kind of that next segmentation.
Exactly, and we're also solving the onboarding program. So we do offer our own on-ramp, off-ramp fiat to crypto.
Amazing. Okay. Well, Chaim, let's hand it over to you here. Quick intro on you, and then the Credix side, please.
For sure, and I think thanks for having us here again, August. A great initiative with the Credix Insights. So my name is Chaim Finizola. I'm calling in from São Paulo today. I'm responsible for everything growth related at Credix as one of the co-founders. My background is in finance at the University of Antwerp. Been into the crypto blockchain side for the last 7-8 years already, but 5 years professionally. And now at Credix, I'm heading everything growth. That means getting very strategic partners like Ankit to join our platform, but as well from other side, make sure that we have the best originators here in Latin America we're focusing on. We're going to discuss much more still today. Make sure that those are onboarded with our team here locally. And then also everything from a strategic marketing standpoint, this kind of initiative that we're aligning, I think, fits very well in this larger growth strategy that we're bringing to the audience. So that's in very short about myself. And then obviously Credix, for the ones that are listening for the first time, we're a global infrastructure connecting institutional investors globally with credit and debt opportunities in Latin America. I'm really focusing on the institutional debt capital market space here and making sure that we can have high risk adjusted returns to those investors globally, but at the same time can provide liquidity and flexible capital for the credit fintechs in Latin America looking to expand their operations in Brazil, Colombia, Mexico, and soon Argentina as well. So that's shortly about Credix and myself.
Okay, awesome. Thank you. One quick technical detour that I'd love to take here. Just looking at, so we're in the RWA space, right, with Credix, and then as we're looking at the underlying loans themselves, these would not be considered uncollateralized or under collateralized loans, right?
Yeah, no, that's correct. So they're over collateralized off chain. So we have SPV structures where we have 120, 130% over collateralization in the form of loan and credit rights. But then on chain, obviously, the credit that comes in is offered to the fintechs and to the securitization companies. So on chain, the money will go out of the smart contract, but off chain, it will then be over collateralized.
Very helpful. Thank you. I think that's just a key piece to highlight in this market right there. So thanks for filling us in. Ankit, I want to hand it back over to you here and dive back into the Mudrex Capital side. Let's start with what drew you and the team to really start Mudrex Capital.
Yeah, sure. Great question. And I think because I come from a TradFi world and I've been a quant for almost a decade, and the team that we've built has been ex-HFT traders from D. Shaw and Tower Research and so on. So our idea was basically to emulate mathematical models of traditional finance world into cryptocurrencies. So because we've been MFT, HFT traders for all our lives, what we've done is we've done hardcore research and tried to basically explore the inefficiencies of cryptocurrency market and try to basically make it all mathematically modeled in a way that we don't have any human biases. So the idea of Mudrex Capital is to do only systematic trading, do only quantitative models which are drawdown control. So we have market neutral strategies which do less than 10% and as a drawdown and have APYs of close to 25 to 35%. And we are doing it successfully for the past 7-8 months since we've been live. We are managing close to $25 million, and we are looking to scale it up to around 50-60 by the end of this quarter. And the strategies that we do run are super scalable, super stable, and super credible. So even in these market scenarios where the markets are very skeptical, very cynical, what I do understand is that our strategies have done exactly what as they were expected to do, because we have rigorously backtested them, we have quantified them, we have had no human discretion being involved in any of these models. And that's the vision of Mudrex Capital. So we're building everything in-house, we are building our infrastructure in-house, we're building low latency systems in-house, and we try to basically capture these small movements and small inefficiencies in the market through our market neutral strategies and generate steady yields for our LPs and for our prospective investors in the coming future.
Okay, really interesting. So you, let's just take 1,000-foot view here. You are a institutional investor looking at investments across the space. Chaim,
Yes.
You are in the space building for those institutional investors. So how is Credix and how are you working to meet those investor needs?
Yes, I think we obviously have different kind of key audiences we're focusing on, right? So we have both TradFi and the Web3 space that have interest in joining us. If you look into the Redder Web3 angle, also there are only institutional capital. So those that we see high net worth individuals, but also hedge funds, crypto hedge funds, large family offices that are already in the Web3 space, different protocols and treasuries as well that are already kind of crypto native. And they're looking to generate sustainable yields. Like the DeFi market last 2 years if you look into the USDC yield, really went down a lot. I think it's something that was foreseeable. The returns need to come somewhere, not just from airdrops on the long run. So I think that's really something that we saw that quite some interest of these kind of more Web3 players in getting involved into this more sustainable yields, and are able to, doing so, invest together with more TradFi hedge funds, which I think, and credit funds, which I think is quite attractive. And then from the other side, we have more and more like credit funds, different credit funds that for the very first time got into crypto just because they understand the credit risk. It's credit risk and not crypto risk that they're underwriting here. We see different investors as well that are very interested in having exposure to the Latin market, what is actually quite a difficult market to, from bureaucracy, country, language barrier, a different country to get into. But with this new kind of digital rails, it's actually a new an easier way for you to access this kind of market and then depth opportunities. So I think we see a lot of inflow of more institutional credit funds, hedge funds, and also family offices looking in the TradFi space for the first time, putting their toes in the water and testing the crypto infrastructure without being exposed to crypto volatility, because they're underwriting credit risk in the end. I think that's been quite attractive to the investors, even with higher risk-free rates. We see that if you're able to provide 12, 13% in senior diversified capital, 16 to 20 mezzanine capital on the dollar in USDC, that has been quite attractive still for those kinds of credit funds that were looking for this kind of exposure. So it really combines the both kind of investors that were looking or for sustainable USDC yield or for LATAM exposure. And I think we bring that together in a very efficient way on Credix.
So that's interesting. Thank you. So that's really interesting. It's something you just touched on that I wanted to actually ask Ankit about. As the risk-free rates rising here with the increase in rates, just thinking from where I sit in the United States, Credix's liquidity pool, it's called a 12% APY right now, dollar on dollar. Ankit, how, as we're seeing that risk-free rate increase where it hasn't been for the last number of years, how has your quantitative investment yield strategy changed over the last couple of cycles?
Yeah, sure. Great question. So every algo, I mean, I'm just going to give you a subtext of how we build our algos and our quantitative strategies. It's every algo or every strategy has a shelf life. So obviously it keeps, it's always in the need of a constant tinkering and constant, modification as it goes along. So, and I'm sure all of these algo creators will agree with me that generally an algo has a shelf life of 6 to 9 months, even though it has taken multiple months to backtest and multiple months to make it live. So the way we treat it is that we basically demarcate different algos for different periods of the markets. For example, if we get into a consolidation phase and the implied volatilities are super low or they are stable, we get into a strategy which basically tries to generate yield based on these stable walls and not getting into very risky trades. So basically we get into more passive trades and not more active trades. Whereas when the markets are, going up and down, or they're whipsawing, or the IVs are super high. So for example, when the entire FTX debacle did happen, people were very skeptical. The implied walls had shooted up to massive 110, 120% on BTC, around 160% on ETH. So our strategies then basically were trading more and more actively, right? So we were trying to not have exposure on the market, but we were trying to basically make money through these small spikes in micro volatility. So every time we did trade, we were trading on diversions in volatility and then basically expecting it to come back, because generally it is a mean reverting strategy. So all of these market neutral strategies are designed in a way that they function differently in different markets. They basically are not the same. When I say not the same, they are not trained to be the same, because if we are running, let's say 6 to 7 class of strategies, the idea for all of them is to be active in a few market scenarios and for them to be passive in a few market scenarios, and the vice versa, right? So for example, consolidation 1, 2, 3 are more passive and 4, 5, 6 are more active, and maybe the vice versa when the markets are super volatile, and we basically do 1, 2, 3 as more active and 4, 5, 6 as more passive. So it basically is how you model your strategies, and the target is to have, we basically optimize our strategies to have minimum risk. And that's why we generate yields close to 25-35% through trading and not through investing or not through staking or not through DeFi yield farming. The entire idea here is to only generate yields through trading. And we do that because we optimize. The first constraint of optimization is minimum drawdown, which is close to less than 5%. And then we basically optimize it for higher returns. And that's how we've been running our strategies, and they've been super fruitful. For example, this month itself, even though markets have been almost 20-30% down, we as a fund are up 6%.
Got it. Okay, thank you. And so within that vertical, within that investment thesis, what role does something like generating yield from Credix's platform fit?
So Credix was introduced to us almost a year back, and I loved the team, loved Chaim, loved Thomas, the guys who built it, and I love the idea that they're building it from scratch from LATAM, and possibly it is impossible for us to reach folks in LATAM because we are based out of the US and BVI, and we wanted to get into synergies where we could partner with funds like Credix who are doing real world asset collateralization, and it's not it's not internet money, right? So it's basically backed by something which is credible, which is solid. So we do allocate some part of the funds to these passive funds like Credix, where we do expect yields from 12 to 15% with almost zero drawdown. And the idea is to obviously leverage more and more folks who come to us and say, hey, look, we are very risk averse. We want our capital to be protected, and we want you to not care about the upside. We are okay with 10 to 15%, as you mentioned, the risk-free rate. We are okay to just match it up by plus 2%. And then we go to people like Chaim, and we go to and tell them, hey, look, we have some LP money that needs to be pooled with you because we also want to diversify our exposure, right? So obviously trading is 90% of our DNA, but we also don't want to keep all the baskets in one nest. So we go with Credix, and we've been very happy with Credix for the past 1 year. We are actually looking to allocate more to Credix.
That's awesome. That's awesome. And that is, so you touched on a couple of things in there that I want to double down on and hand the ball back over to Chaim a bit. So you were able to diversify while getting a more, let's say, dependable yield. No, that's not financial advice, but a more dependable yield than something like trading volatility in a previously inaccessible market that is now accessible using a platform like Credix. So you're both using blockchain to not only improve investing experience, but tap into these new verticals. Why blockchain though? Chaim, could we not do this through some other facet? What is the value out of using the blockchain?
It's a question that obviously comes to mind quite often. And if you really think about it, like if you want to do it very manually, probably you would be able to do it in a less efficient way without needing or using blockchain. But if you can use a more efficient technology, why not do so, right? And so I think that's really when you look into this technology by default global. So you have like investors in Singapore depositing and investing in debt, and it's like 30 seconds later here in Latin America, ready to use. So that already free of cost, like it's so much more efficient from a capital allocation, capital movement side. So I think that's the first one. Second one is really like, if you look into the credit history, it's something that's very opaque and not transparent in the more TradFi space. So having like history on chain of the repayments of the fintechs, that builds a lot of trust. So if you want to provide additional debt facilities to this kind of fintechs, you as an investor have on-chain proof that they paid back over the last month. So it's also something very interesting. Then you have really efficiency of having everything on a smart contract level defined. So interest repayments come in automatically, our smart contracts will allocate it to the right investor that invested through their USDC, and they get their token as a representation of their investment. And so everything is handled fully automated. So a couple of credit funds are actually bringing their own deals on chain just because of the efficiency of the administration of the deals on chain. So that's another very good example of where the smart contract angle of the blockchain comes in as well. And then you have obviously the modularity and combination of other DeFi protocols, which is something very interesting to explore as well as a super senior layer, for example, to give additional leverage to other kinds of folks that are investing through the platform. And then looking more ahead in the future, like being able to do securitization on chain, tokenizing really the receivables, and having more overview of the underlying assets and monitoring that also on chain. So there's a lot of opportunity to still explore in this very early economy, but it's very promising. And I think those are just a couple of the reasons why we really believe in the efficiency of using blockchain technology as a global infrastructure to build the next generation debt capital market.
Amazing. Thank you. And so transparency, that's something I want to come back to in just a moment.
I just want to August, if you don't mind, I just want to just reinforce what Chaim said about, I think it's all about accessibility. That's number one, because it really makes it super accessible to people around the world to, tap into LATAM. For example, we, as a US fund, we are dealing with Credix because they are tapping into the RWA of LATAM. And number two would obviously be traceability, which kind of builds trust, right? So if you can trace, it's like an anchor, right? So the anchor is the end part, and it's like a chain where every link leads to the anchor, right? So it has to be absolutely traceable, and blockchain is absolutely traceable. So, and it has widespread applications. It cannot be only with us, because obviously we are one of the first movers. We are building the finance infrastructure around it, but there's going to be healthcare, there's going to be insurance, there's going to be road transport, and everything else is going to be built on blockchain. So it's the future.
I think that's a very important point. Like, if you look into a fund that's allocating capital here in Latin America, you're believing the reports that they are posting on maybe a monthly basis. Yeah, but exactly. How can you 100% be sure? If you look now I'm going to app.credix.finance to the different deals. You can select the public key there, and then you can see the history of the repayments of the credit fintechs on chain. So you have really certainty that happened. So I think it's really different in that sense. And also you have control of your public keys, of your tokens, of your investment, without having to handle the money to Credix, but doing that through the platform directly to the wallet of the securitization company of the fintech. So it's really this transparency and accessibility, as Ankit mentioned, it's really differentiation. And I think we're starting to see the adoption of it more and more, and it will only go faster.
Yep.
Ankit, thank you for cutting me off, because you answered my question better than I could have asked it. So thank you. That's absolutely perfect, and that's spot on. Exactly where I was going for. I come from a TradFi background. I've seen these efficiencies. Wanted to hear it from your perspective, and so spot on. On that transparency that we keep coming around, I think that's so critical right now in the market as we're seeing everything that's going on. You're both relying on some trusted third parties, maybe from the front end, the AML, KYC, KYB, et cetera, to some of the back end players. What's your due diligence process for choosing these centralized partners? I'll just throw that question out there, and maybe whoever wants to tackle that first, just jump on it, please.
I think we both will have very, very different approaches to our due diligence, because obviously we run separate kinds of fund, as you mentioned in the beginning. For us as a trading fund, the number one idea, as I said, is to not put all eggs in one basket. So even if we do trade with exchanges, we do deal with counterparties like Binance and Bybit and Deribit and so on and so forth. We make sure that we are not overly allocated to any of these exchanges. So to give you an example, we've had zero impact with the FTX debacle. I know it kind of sounds weird, but we kind of did our due diligence. We had our own reasons to not deploy on FTX, even though FTX was the number 2 exchange after Binance. But and I'll tell you why. Because when we were testing out our market making strategies and our market neutral strategies, the order book depth then was very shaky. It was shady. It was incomplete. It was manipulative at the least. So when we were trying to kind of emulate, so I don't know, it's going to be a little bit hard for retail people to understand this, but when you try to build a market making strategy, what you do is you capture order book depth at every tick or every trade, right? And when you do that, you basically are trying to train your systems to build that order book when it's in the future. So and also to try to capture your trades into that order book and how it reacts basically on your trades. And every time we did this with FTX, it always kind of haphazard, right? It was never what we expected. We never had trust with FTX. And I kind of mentioned it on my other podcast also, that this is a problem with FTX, and that's why we're not deploying. And we had zero impact because of the FTX debacle, which is very, very weird, because most of our LPs are super bullish on FTX, and they should really, really thank us that we had not deployed on FTX. So that's number one. I mean, we have a really tight due diligence on what we do and how we do, and how the exchange is reacting to it. Number two, obviously, we do have wallet solutions. We have counterparty risk management solutions. We have custody solutions. So, for example, we use custodies like Binance, and we use custodies. Binance custody, by the way, is an entirely third entity. It's not Binance. So it is not. If, for example, Binance goes down tomorrow, we are not entitled to the same entity. But apart from that, we also have custodies like Copper. We are working with wallet solutions like Liminal, and so everything is. We are trying to get into the market where we are more and more regulated, and where we are more and more controlled. We're also getting into OTC trades with the big ones like, Galaxy and Amber and so on and so forth. So the idea is to not just blindfoldedly trust one exchange because it is the biggest exchange. The idea is to basically place our bets on different counterparties, and even if one of them goes down, for example, in the worst case scenario, we should not be hit by more than 5 to 10%.
Okay, thank you. So you're doing a really deep due diligence, kind of. I'll just say from the inside DeFi space, looking out at the players that you're interacting with there. Now, TradFi investors, traditional finance investors, family offices, etc., that aren't as familiar with this DeFi sector, maybe they don't even have a wallet set up. They're going to really kick the tires and dig in deep on a platform like Credix, right, Chaim? And maybe some of these recent market disruptions have made them a little bit gun shy, a little bit hesitant to enter the space. What are you saying right now to reassure them? And perhaps also within that, just touch on what are you doing to assure that their assets remain safe throughout the process, as safe as possible?
Yeah, I think if you look into Credix, we're decentralized. We don't have any dependency indeed on this kind of more centralized exchanges. We work with third parties for KYC and accreditation, and we do that through Securitize, which we deem a very transparent and good protocol without also any financial dependency there. And then we work with those fintechs, loan originators here in LATAM, where we do extensive due diligence on, right? So we meet them in person, we go to their loan tape, we go to their financials. We work very closely with them to make sure that it is what they are saying. There is also third-party audit. We have then the underwriters, which are specific credit funds, also doing the analysis on the credit. The credit is also allocated, the credit rights to ourselves. We're also doing an analysis on that. So it's really more an institutional DCM play that we're playing here. And so from a crypto standpoint, there isn't actually a lot of crypto exposure or volatility here as well. We have like every big update, we have public audits that we prove and share as well. The way that our programs and our Rust programs are designed are as well shielded from other potential conflicts. And then, obviously, the money that comes into a platform is also going to be lent out. So there is actually not a lot of capital on our platform that can go anywhere. Our investors and our fintechs, they also always need to go to KYC, be whitelisted on a platform to be able to interact with the platform. So that's another assurance that we have as well. And then we have all the legal contracts on the underlying assets. So if anything would go wrong in the end, we still have the fiduciary assignment of the underlying loans, of the underlying cars, and so forth, and so forth, and so forth. So I think we have like 7 or 8 different layers of security measurements to make sure that we can comply with the highest requirements of our investors and of our ecosystem in general. I think that's a little bit how we bring the message as well to our investors, and what our investors also understand. They are not investing in different systems that are very sensible to the volatility of crypto or dependent on token rewards that they have been issuing for the last years. Our platform is really an institutional USDC-based platform where it's entirely backed by sustainable real-world returns coming from these loans in jurisdictions like Brazil, Colombia, and Mexico. So I think that's really how we differentiate ourselves, and it's something, this credit risk that underwriters and family offices are underwriting is something that attracts them.
Got it. Okay, thank you. So you mentioned the KYC and the KYB, which is kind of in, I'll call it the broader regulatory standpoint, the area, which actually hits on an audience question. We had a couple come in over the past few minutes here while we were chatting, and would love to jump over to a few of those and perhaps hand this one over to Ankit. But how do you see regulation entering the space either today or down the road? And then I understand that's a broad question, so tackle it as you'd like.
All right, thanks. And I think this is a pertinent question, and it's a perennial question for everyone doing crypto anywhere in the world. So my bottom line for everyone is that regulation is good. It's not bad. We should not avoid it. It's only regulation that will help people like us and Credix to survive, because we are doing everything right on the books. We are trying to emulate everything that is there in the traditional finance world to show our audit book, to show our audit reports, to show our a NAV calculation, which is done by a third party, and so on, and KYC, AML, everything else. I think it's absolutely prudent for us to follow these these regimes. And even though the regulation might take a while, so I'm not saying it's going to happen in the next 6 months or a year, but there will be, it will be a case which cannot be, so it's going to be an offer which cannot be refused for governments, basically, right? So I'm sorry, I'm misquoting Godfather, but that's how it's going to be for even governments, developing economies like India. So because the scale has become so big that you just cannot ignore. You cannot just say, hey, look, I can't deal with cryptocurrencies, I'm banning it. It's not going to be the case. It has to be regulated. It has to come under the purview of regulation over a period of time where people do understand what exactly is the impact and is the repercussion of having one trade on an exchange, for example, or having one allocation to a DeFi protocol on the on-chain wallet. So these things will come into play, and probably, hopefully, in the next 2 to 5 years, we'll see more and more governments coming and basically acting into these environments. But I think I read it yesterday that Brazil made it open for Bitcoin, cryptocurrency trading or Bitcoin transactions. So that's a great step. I think it started with El Salvador. I think there are a couple of other really developed economies like Switzerland, which do cryptocurrency payments in groceries, and even some of the other countries like Singapore. But I mean, it's a very vague topic, as you mentioned, August. I cannot really pinpoint on how or when or what regulation should come in. But what I would say is we would be really happy if regulations do come in, and because we are not scared. I mean, we are not trying to do something which I don't want to mention a few names, but some of the other funds did, right? Because they bought boats and they bought yachts and they bought planes. We are trying to just be fiduciary responsible. We're trying to make money for investors, because that's how we grow our name. Getting to grow from a $25 million fund to a $2.5 billion fund will not happen if you're doing shady business. It will happen because you are complying to something, right? And especially in this market. And this bear scenario will only be appealed if we have more and more of these institutions and regulations coming in. So, for example, if JP Morgan does step in, and it has stepped in, it will not do it without regulation. I mean, it will not expose its clients to something which is absolutely arbitrary. So, yeah, I think it's going to be a major component for the next bull cycle to come in.
Yeah, I think it's a natural progress in the crypto space. I think we had our Wild West period. I think there are still applications that will work in a more non-KYC manner. I think there are use cases for that as well. But I think the more you want to go into building this kind of infrastructure, connecting real world with the crypto space, there is just a requirement to have some legitimacy and some identity in place there. And I think it's more than normal. And the stance is just what Ankit mentioned as well, like the regulators, they're actually looking at it with quite an open eyes and an open mindset. They're looking to understand and learn and actually really come with regulations that make sense. And just last week, I was at the central bank here in Brazil speaking about what we were doing. It's really well received. They really understand what we're doing. They really like what we're doing. They understand the social impact that it can bring. But it's normal that if you want to tackle into a debt capital market ecosystem in Brazil, we need to be able to identify who is interacting and lending money to those Brazilian companies. And that's not rocket science. That's just how it should be. And we're very bullish on that. But I think it comes down to finding the right regulations that are somewhat aligned between different jurisdictions, and then make sure that we follow up on that to also not have the debacle that we just had recently in some other cases. So I think we watch regulation with good eyes here, August, and I think that's an important takeaway.
Yep.
Thank you. I think that's really important, watching that regulatory rollout, just so that if we know what the rules are going to be, we can build better for the future, in my personal opinion. And so I think keeping an eye on that and playing a part as much as those in the space possibly can is going to be really beneficial.
Absolutely.
We're over on time here. We got one more question I really want to get to regarding Credix's decision on what they're focusing on. Chaim, what was behind that decision to tokenize private credit as opposed to other real world assets? I think RWA's real world assets is the biggest possible asset classification in the world. Why specifically the ones that you're focused on?
I think if we looked into LATAM, just credit is extremely expensive. It's like Brazil is top 3 in the world. There is a huge market. We have over 500 credit fintech just in Brazil, doing more than 10 billion a year in origination in dollars, growing at 400% a year. So it was just a very big opportunity. It's like also yield and return wise, it makes a lot of sense. Also if you want to diversify it on chain and you want to get this kind of partners onto a platform, it made more sense. Just from an asset class, it was quite straightforward and was something that we believe we could really understand well and support them in their growth, and became the first asset class that we decided to bring on chain. So we really have our team that's specialized in private credit here in Latin. We have our investor base that understands that as well. And if you want to provide higher returns, private credit is still a very attractive portfolio. And we see that a lot of, like, over the last 10, 12 years, more and more portfolios are starting to include this kind of alternative, and private credit is becoming a more and more important part of those portfolios. And it makes a lot of sense for us as Credix to tap into that and make sure that investors can have this access to this kind of alternative assets, which end up being this private credit.
Awesome. Thank you. I think that's a great point to follow up on, or end on rather. And I do want to, however, just open it up to either of you right now. Is there anything that I haven't interrogated you on that you'd love to highlight or just bring out? Any questions for one another that you want to take a second to ask?
I think we covered a lot. It's a lot to digest also, but I think the future for us, and I truly believe that the future for investing or trading in cryptocurrencies would be through systematic trading. And it has happened in the traditional finance world. It has happened through ages of development. And I think we're just going to reach there faster because people like Chaim and me, we are from TradFi world. We're getting our knowledge of TradFi into finance and into cryptocurrencies with better implementation and with more secure implementation. So I would really advise people to not try to time the market and try to be more selective. So I keep saying everyone that, look, everyone, when the market is super greedy, you should be really, really careful. And when the market is super careful, you should be really, really greedy. So I think with us, as Mudrex Capital, as a quantitative fund, we try to actually not encapsulate any of that, and we try to just believe in our systems that we built, believe in the strategies that we built, because they work for us, they work for innumerable hedge funds in the world for equities and FX and commodities, and we're trying to emulate the same thing in cryptocurrencies. And this is the future. So we're just building the first layer. So any ecosystem that is being built, for example, even human civilization, the first layer that was built was basically currency, right? So economy is not built in a day. You build currency and you build financial systems around it, and then you build the economy, and then you build everything around it. So we're just building the first layer on blockchain, and then there's going to be more and more and more. So probably our kids or maybe our grandkids, and we probably will not be even using our Macs and Windows. We something cool on blockchain.
Yeah, I think from our side, we're like, obviously this moment in the market, it seems very doomed and dark and bearish, but I think we went to breakpoint as well, like everything happening, a lot of development, like the teams are not stopping at all. By the contrary, there are more and more devs entering the blockchain space. We have more and more high quality funds that are diversifying, are following more regulation, are being more cautious. I think really great example is Mudrex here. I think we've been partnering for a long time, and I think 2023 we will keep growing our collaboration together. We're very bullish on that as well. I think what we're like, this real world asset space is growing quite fast. More and more it will become a standard 5 to 10 or even 15% of the portfolio of different funds. And I think like as Credix, we're very, very excited about what 2023 has to bring. Growing the team, growing our presence, growing the different asset classes, diversifying even more the liquidity pool, and getting more partners like Mudrex into our ecosystem. So yeah, really looking forward to growing the space.
So a couple of keywords for both of you guys there that I just jotted down: growth, future, building, and 2023. So clearly we should all be watching not only your individual projects, the entire space though, but let's ask and close it out here because I've taken too much of your time. Ankit, where can we and our kind viewers go to learn more about Mudrex and Mudrex Capital?
The easiest way to actually would be to email me because we do have an app, and you can download the app on your phone called Mudrex. But my email ID is pretty simple. It's ankit@mudrex.com. I'm also available on Telegram, but it's going to be a little bit hard to pronounce it. So easiest way is ankit@mudrex.com or contact@mudrex.capital. And we'll send you the details. And if you're interested, would love to chat and get to know more.
Awesome. And from Credix side, obviously, if anyone is looking to learn more about Credix or looking to invest through our platform, can go directly to credix.finance and learn more. You can reach out over Twitter, LinkedIn, or the website itself to see how we can start collaborating in the future. So thank you very much, August, for setting this up and moderating this great panel. I really enjoyed your presence here, and let's continue building.
Yeah, sure. Awesome. Thank you, guys. Thank you, August. Thank you, Chaim. Thank you, everyone.
It's been an honor. Thank you to our audience. We'll put that contact info in the show notes, and look forward to seeing everybody here in the next one.
Awesome.
All right. Take care.
Thank you very much.